Well, oil prices are on the rise again over concern about even tighter supply as conflicts escalate and perhaps threaten to reduce that supply even further. Oil certainly has advanced. We're hanging above that $80 per barrel mark. And over the last year, oil producers in both the U.S. and Canada have outperformed the rally in crude. But recently, in 2024, these oil producers have actually lagged the move in oil. Let's bring in David Szybunka. He is the senior portfolio manager at Canoe Financial. David, thanks so much for being with me. How fussed, if at all, do you get about these oil producers lagging the near-term rally in oil prices?
Yeah, we don't get that concerned at all. When we look at the backdrop of oil, we've tried to get our investors to focus off of the oil price and more onto the stocks like you were kind of just mentioning. On the oil price, it's now up 14% year to date. I mean, 2, 3, 4 weeks ago, it was kind of flat on the year. It started the year in the low 70s. Now it's in the low 80s. We're bouncing around up and down. But beneath the surface, don't forget, our Canadian producers get paid in US dollars. And so condensate prices are $105, light oil prices are $105 a barrel. Heavy oil prices today are $93 a barrel. It's really good for the producers, whether it's $78 oil, $73 oil, $84 oil. It's all very constructive for the sector. And we've been trying to focus investors on the profitability and a little bit less on the commodity.
Let's talk about that earnings story. What kind of earnings growth are you expecting broadly? And do you think that's fully appreciated by investors?
We don't. And when we look at energy's weight within the S&P, look, we're still 4% of the weight and we're just about 10% of the earnings. And so we keep trying to identify to people, look, the prize is when the weight goes to the earnings. This happens over time. It happens through a cycle, but that is the opportunity. When we look at other sectors, the weight is above the earnings to a big degree in some other sectors. And so this involves sector rotation over time. I don't see sector rotation on the year as it relates to energy. Everything, all these sectors have done quite well. So we still think the big opportunity is when we get into a more rotational market for energy, but all of the right things are happening beneath the surface.
And we've seen it in certain instances. I mean, we saw some of our producers like Canadian Natural Resources surge to all-time highs on the back of its earnings. The refiners in the U.S. are at all-time highs. When you look at the broad and the different ways to play it, U.S. versus Canadian producers, refiners, the services, the pipelines, the producers themselves, are you all in across all sectors, or are there certain slices of the energy market you prefer right now?
You bring up a really good point, and that's just on how we always have told our clients we manage the capital. We invest in subsectors, and so we're constantly looking at the various subsectors of energy and trying to identify which components to have exposure for our clients to. And when we look at the year, like I think about very constructive things that we did where we took our refining weights up last November and we took our oil weights down within the funds because we were expecting a choppy oil market. You brought it up, refining has been one of the best performing subsectors on the year. Our Valero, our Marathons, they've done very, very well. But we've taken profits into that. Now we can't find a refining bear in the room. And it's not that we're all bearish refining and think spreads are going to pull apart, but we've been in a product-driven market to start the year, which has dragged up oil prices because of the product market. And now when no one can be bullish on, or everyone's bullish on refiners, that's when we tend to take our weights down. And we look to take advantage of other subsectors.
Like what? So shifting, taking profits from refiners and putting them to work where?
Yeah, so I mean, the example is we took profits on our Marathon, on our Valero, and we actually used that check back in CNRL into the low 80s, Cenovus into the low 20s. We took advantage of those specific oil names because we were seeing that the oil fundamentals were improving. You started to see U.S. supply on the year start to roll to some degree when everyone thought it was going to keep growing. And so the right things have been happening there. We took up our oil weights. I'd say a big education for the clients is there hasn't been sector rotation, as I just previously talked about. And when you don't see sector rotation, a lot of the capital goes up cap. And so we've seen the large caps do really well on this rally. We're watching multiples diverge from each other. As we play out the cycle and the multiples start to diverge and there's cash in the system, we keep saying, look, you should be starting to think about some of the parts, net asset value, optionality, and we're doing that. And so you want to ride the winners. You want to take advantage of pullbacks you got to respect that we're not in a rotational market yet. So you do want to stay up capped to some degree, but don't forget about some of these intermediates because you want to start putting some capital down. We have all the ingredients here for M&A within the sector. And when M&A starts happening, investors are going to react. And we're trying to get in front of some of that today. The producers always are the smartest buyer of assets, and there's a lot of cash in the system today, and the valuations are diverging.
Any obvious M&A candidates?
It's hard to say. Like when I've been on previously, we've talked to investors just on how some of the bigger producers like a Suncor, we think that these guys get aggressive and get bigger through the cycle. We see base mine kind of assets coming down over time on the production side. And so we could see them buying more oil sands, but the conventional energy companies within, say, the Montney, these are really good assets. Like I said, condensate prices are $105 a barrel. Not all of these multiples are re-rating. And so we think that there's a natural progression through time that some of these bigger entities will go to take advantage of some of these undervalued molecules within the sector. And then everyone will react to that. And so we're putting more names in or more exposure in our funds to the Montney because of that. It's a little bit hard to keep up in the meantime as it relates to these large caps rallying, but we think that's the right call.